Between fear of missing out and holding on to losing investments for too long, your own brain can lose you tens of thousands of dollars. In this video, I'll reveal the 5 ways bad investor behaviors cost you money, how to spot them, and how to make sure you don't make the same mistake twice. We're talking stock investing rules today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, whether you're just starting to invest or you've been investing for years, you need to start here. What I'm about to show you is something nobody talks about, but it's the #1 reason investors lose money in stocks, the biggest obstacle to making money. It's you. You are your own worst enemy when it comes to stock investing. In this video, I'll reveal the biggest behavior mistakes in investing, all the biases, the fears, and just plain mind tricks that you'll need to overcome if you want to make more money. I'll explain each behavior, how to know when your brain's playing tricks on you, and how to avoid it. It's all part of a special investing education series that I'm starting, showing you what it really means to analyze stocks and invest your money. I'll be using content straight from the curriculum for the Chartered Financial Analyst designation, the gold standard for stock analysts working on Wall Street. The designation involves 3 years of exams and thousands of pages of curriculum, but I'll be laying it all out for you in these videos. I'm going to be putting this one and all those videos into a playlist called How to Invest in Stocks right here on the channel. Make sure you tap that subscribe button so you don't miss any of these, because I've got some great in-depth videos coming, from options trading strategies to technical analysis and just how to be a better investor. Nation, to understand why beating these investor mind mistakes is so important, you first have to understand that most investing advice out there is just plain wrong. Most advice hinges on the idea that investors act logically. They analyze stocks and the market and then make decisions based on the facts. Yeah, investors are about as rational as a submarine with screen doors. From tulip mania to the dot-com bubble, investors follow the crowd and they follow their gut. So behavioral finance builds in those biases and the weird tricks our brains play on us while investing to beat those subconscious tendencies. Now, how can you use this video to be a better investor? I'm going to reveal 5 ways your brain plays tricks on you and makes you lose money. These are the investing mistakes that nearly every investor makes, whether you're a beginner or a pro. I'm not going to lie, beating them is going to take work. This is some deep psychological shit right here. Beating these mistakes means first understanding what they are and realizing when you've made them in the past. It's a kind of investor confessional to clear your soul. Then, before you make an investing decision, revisit the list to make sure you're not making the same mistake again. And as a commitment to yourself, I want you to watch through the list and then leave a comment below about one time that you've made one of these mistakes. It's only this kind of self-knowledge that's going to help you understand and beat these mistakes, so think through these and leave a comment below. Our first stock investor behavior is called loss aversion bias, and I started with the worst here because this one alone will destroy your portfolio. And now all of these investor mistakes are going to have some fancy psychological terms, but I'm going to give you examples of each, and I guarantee you're going to get that aha moment and realize that you've been making a lot of these without even knowing it. Now, loss aversion just says that emotionally, losses are so much more powerful than gains. A 20% return is nice, but a 20% loss will make even the tough guys cry. Our brains just don't react the same to gains as they do to losses. We end up taking more risk to avoid those losses and take less risk to increase our returns, which is actually just the opposite of what we should be doing. For example, a lot of investors will sell their winners quickly, being content with locking in a 15 or a 20% return, but then they'll hold on to their losing stocks and even buy more. They avoid that pain, the reality of the loss, by deluding themselves that the stock has to rebound. In fact, what should be happening is you reduce your risk in the bad investments by cutting your losses fast, and then increasing your risk in the good stocks by buying more. But our brains just don't want to let us do that. We go from investors to gamblers really fast and wake up every morning just hoping to get back to even in that investment. Losses suck, folks, and I've been pulled further and further into a bad investment myself. Avoiding it means a formal approach to investing. Now that means writing down your rules for stock investing. When do you invest more and when do you cut your losses? You need a checklist for analyzing a stock and what you're going to do if a loser doesn't meet up to the criteria, because if you just wing it on a case-by-case basis, you're going to end up holding these bad stocks way too long. Next here, overconfidence is one that actually gets worse the more you learn about investing. Now, this is the irrational belief in your own skill or your ability to pick investments. That supreme confidence that you're gonna be right. Nation, if you ask 100 investors if they're below average or above average investors, you're gonna get 99 above average investors and one seriously disturbed individual. And come on, it's natural to think that you can make better investing decisions. You spend time researching and learning, and statistically, 50 of those investors are gonna be better than average. They're the 50 investors watching this video. But when you get overconfident about your ability, you tend to do less research. It's ironic because the learning and the research that you've done in the past to create those returns, that's what makes you overconfident and then makes you do less of what made you successful. You rely more on your gut and less on the analysis that actually did make you a better investor. Now, another part of this overconfidence behavior is you attribute your wins to your ability. It was your awesome investing skills that found that right stock, but then your losses are dismissed to some unavoidable event that wasn't your fault. And so what we see in overconfident investors, they underestimate their risks. They chase those high-risk investments because they think that superhuman skill is going to tell them when exactly to cash out and exactly how to play it. They trade in and out of stocks and they just end up losing money. Now, beating overconfidence bias is about being honest with yourself. Look at your investments over the last year or two. How did your total return compare with the market? If you missed the market returns, then it's time to eat a little humble pie. It tastes like shit, but we all have to do it occasionally. And after looking at your whole portfolio, take an honest look at each investment as well. Did you get lucky in a few big wins and that saved your portfolio? Just because you beat the market doesn't necessarily mean any great investing skill if most of your stocks underperformed. And here, if you did underperform the market, that's all right. You've just got to be honest with yourself. Continuing to think you're the next Warren Buffett isn't impressing anyone, and it's just costing you money. Instead, maybe it's time to take a little more of the weight off of your picks and put more into a group of stock funds that are going to get you that market return. We've still got 3 more stock investing behaviors to reveal, but first, I want to personally invite you to get the Daily Bowtie, my daily market update that's going to give you all the trends, strategies, and the important news you need to invest your money. It's completely free, just something I like to be able to do for all you out there in the community, and it's completely new this year. I'll leave a link in the video description below, so check that out. The saying goes that hindsight is 20/20, but I say hindsight is a bitch. Hindsight makes you think you could have or should have predicted that 1000% investment. It makes you sit there fantasizing about getting rich and gives you the FOMO that makes you jump into the next get-rich-quick scheme you see and then loses your money. And hindsight is really based on the fact that we remember the events that happened with crystal clarity, but not the situations or what didn't happen. We remember those huge gains in Bitcoin and then all the articles and our friends that told us to invest, and we feel that crushing regret about not jumping into it. But you see, we never think about all the recommended investments we didn't buy that ended up being a giant turd. The Bitcoin bulls like to point out when they recommended it last year, but then fail to point out their historic misses, like predicting coins would rebound to 25,000 by the end of 2018. Instead of falling further to 3,500. So we remember these huge missed opportunities, and when the next high-risk, get-rich investment comes along, we just can't resist. Nation, honestly, with the rise of social media, it feels like the stock market has just become one big pyramid scheme. And people don't analyze stocks anymore. They just run to social media, ask for a quick stock idea, and then buy in. So when you get 1 million people talking about the same investment, it's not about value anymore, but about how many people you can get to follow you into it. Beating hindsight bias and this fear of missing out is about really thinking about those past investment scenarios. When you feel that regret of missing out on that 1,600% rise in GameStop, remember also that the shares lost 91% of their value over the 5 years to July as revenue plunged 30% in 2 years, and debt was 250% more than the market value. Realize all the risks that investors at the time were confronting, and don't think any investment was the obvious choice. You also want to be careful when you're comparing current investment opportunities with ones from the past. And people love to prove something is going to happen to a stock just because the market did this or that in the past. And it's all bullshit. Just because the price of a stock went higher after breaking through some level, or just because the market was up in January, all these little anecdotes really mean nothing for the future return of a stock. Now this next one goes way beyond stock investing. Confirmation bias. Now this is the tendency to look for the information that confirms or proves your belief, and while also ignoring or undervaluing any info that contradicts that belief. And in fairness, this one has been going on before social media, but oh brother, how it's gotten over the last few years. Through your past interactions, social platforms like Facebook just changes what you see to only show you those posts that align with your beliefs. You get pushed into this cocoon of information that amplifies your opinion and hides anything that challenges it. But I'm not here to change the world. I'm here to help you be a better investor. So we're going to tackle one problem at a time. Confirmation bias means that you only read articles or that analysis about a stock or the market that validates what you already think. Think the market's going to go up? Then you're less likely to even click through that article about the bubble in stocks or the risks. You're only reading articles with a positive headline and avoiding those dissenting opinions. Even if you do read something contradictory, you undervalue it with some kind of reasoning to avoid building those facts into that pre-existing narrative. And of course, when you only seek that confirming evidence, you just get more set in your opinion. Hell, everything you read is telling you that you're right, and you miss that real evidence that you should be paying attention to. Now, the best way to beat confirmation bias is just to consciously build into your decisions time to play devil's advocate and genuinely look for the other argument and just list out the pros and the cons next to each other. Anchoring bias is another one with a fancy term, but actually a very simple definition. This is where you create an initial opinion on something, a stock value or an estimate for earnings, and then you hold strong to that, only changing it very gradually, even against overwhelming evidence. And if you've ever wondered when to sell a stock or how to tell when you're wrong about an investment, this is the biggest stock investing behavior you need to beat. Anchoring causes you to decide that a stock is worth a certain amount or that earnings are going to come out above expectations, and even when the information comes along to call that into question, you don't adjust your opinion enough to avoid losing money. Basically, any new information you get is going to be warped through that lens of that initial opinion. This goes beyond just ignoring the information like we saw in that confirmation bias. Here you might actually read it and be open to different opinions, but you just don't move your prior estimate much, even if you should. So here you've just got to understand that the market, prices, and stock values are constantly shifting, and that past information is actually less relevant than the new info. In fact, if nothing else, that new information you get should count for more of your analysis, not less. Click on the video to the right for the 8 questions every investor needs to answer and the simple strategy that turns little amounts to invest into hundreds of thousands of dollars. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.